we're going to go ahead and get this party started. So thank you very much. Burt Copeland here with New Life CFO Services, and this is part two about money matters. Are your numbers ready for the Shark Tank? And the subtitle is, Are you just chum in the water? So it's a 5-part series. The first part that we did back in September was really about just the totality of your financial statements. And today we're going to focus just on the P&L and what really makes that bad boy hop. For some of y'all, you may notice that my background looks different. I've moved offices, so I don't normally have Ronnie shining in the background, but he is one of my all-time heroes. So today, Ronnie's with us too. With that said, we're going to go ahead and get started. So if you think back to the Shark Tank, a lot of y'all watch The Profit, and a lot of other really great business shows that are out there, especially on CNBC. So what is the number one thing that they talk about in Shark Tank? There's a couple of things that they will bust on one of the applicants all the time. And first and foremost is going to be the entrepreneur doesn't know their numbers. And not only doesn't know their numbers, but they don't know what their numbers are telling them about their own business. And that's what we're really going to dive into. So today, while we're diving into that, we're going to be really focused on the P&L, understanding its purpose, how to use it to not only understand the health of your business, but also how to use it to drive performance in your business. A lot of y'all have seen me talk before, and one of my favorite lines in the world is your numbers need to create an appropriate level of anxiety to take action. Let me do something here. I'm going to share my screen slightly differently so that we have a little audio and visual going on. So bear with me for just a second. There we go. So unfortunately, now you have to see me, and now you can see Ronnie in the background that I was talking about. So it's all good. So when those poor souls are out there being berated by the sharks, them not really knowing their numbers, it's stunning how frequently that happens. And you're like, gosh, you're an entrepreneur, you're pitching to some very sophisticated investors, and yet you don't know your numbers. Now step back from that and think, how many of us, when we're not under the stress of presenting to a bunch of entrepreneurs, still aren't really totally familiar with our numbers, and sometimes maybe rationalizing our bad numbers for whatever reason. If you ever find yourself rationalizing bad numbers, park it, right? Because you're allowing somebody else's excuses to creep into your mindset, and that's not healthy. Keeping the excuses out of the vocabulary helps to create more and more accountability, urgency about getting to the right thing. So as we always talk about, your financials, they're nothing more than a historical reflection of your people, their decisions, behaviors, processes, and systems. And hopefully what your numbers will tell you is where you need to change your people, their decisions, behaviors, processes, and systems. I'm glad that there's a lot of familiar names on this LinkedIn Live thing that we got on, but some of y'all are probably sick of me hearing that, because this is a universal truth that we'll talk about all the time. Now, your CFO, like myself, our job is to create metrics to help you better understand your numbers, but also to help you see where those changes should happen, and prioritize those changes into which ones will either help to stabilize the infrastructure, help to give better information, or really help to drive that performance. And please know, for some of y'all that are in the audience, that you have a staff, it doesn't mean that you need to be driving the numbers. So when you get into the P&L, we're going to share this. Hopefully you can share it with your folks, but share it with them, because part of the people you want to have drive the numbers is everybody else in the room. Because if everything is on your shoulders, it's really hard to get that much heavy lifting done. Now, we've talked about this before. When I visit with CEO groups, I'll ask them, hey, when you get your financials, tell me about the first three things that you look at. And frequently it's not only the first three things, it might be the only three things that they look at, but here's 1, 2, and 3. We're not going to focus on cash balances today because that's balance sheet. We're going to do that in our November session, but obviously revenue and net income and EBITDA are all about the income statement. So when we start looking at that, let's go back to what is it that our income statement is really supposed to be telling us? How fast are you going? Right? So that's all it tells us. It tells us how fast are we going and how much are we creating along the way. When we get into the balance sheet, that really tells us how healthy our company is. We're not even into health right now. There's a few indicators that we're going to get to later on in today's presentation that talk about health indicators on your income statement and why those are important. But this is really about how fast you're going, how fast you're going now versus last year, how fast you're going now versus your plan, or more importantly, how fast are you going relative to everybody else in your industry or benchmark? It's stunning to me how few CEOs really understand the true norms of their industry. For any of y'all that want, we subscribe to a huge database of benchmark reports by NAICS code. So you raise your hand and send us your code, and we'll be happy to get you your benchmarks. But it's very important to understand that because these benchmark reports, it's average performance. That's all it is. It's not the upper quartile. It's not the upper 10%. It is average performance. And so when you look at some of these benchmark reports and go, wow, that number is better than my number, just know that that means that you're below average, right? So I don't know of any entrepreneur that goes to a happy hour and brags about that their numbers are below the industry average. In fact, for most of y'all, it's just viscerally unacceptable to be below average. You certainly don't consider yourself to be below average. And I thought you consider your people to be below average. And likely, while your company may be struggling right now, for the most part, you don't consider your company and your products or services below average. So let's not accept below average. But as we go through that, because we're looking at the revenue and our net income, it's really like looking at the two pieces of bread there on the left. It's a sandwich, and all you're looking at the top slice and the bottom slice. But with any sandwich, the things that makes the sandwich good, tasty, interesting, and make you want more is everything in between. Is it more or less tomato? Are we going to have lots of lettuce or more pickles? I'm a big fan of pickles myself, so I'll opt for the pickles every time. But that's really how I want you to be thinking about your income statement. I want you to become intimate with the things between the bread, because it's those items that'll tell you if you can create the results again and again and again, or do you have process problems and productivity problems? That's going to be a big part of the fun today is when we jump into that. As a reminder, your financial statements, and in particular your income statement, should look like this iceberg. And what does this iceberg do? What's the universal truth of all icebergs? Well, it's that 10% of the iceberg is above the water and 90% is floating underneath. Your financial statement should be the same thing. For example, your financial statement should show the 10%. And that information should tell you, is everything else below the water okay? And if it's not, that 10% should tell you where to go below the water to find out what is or is not okay. What is way above expectations or way below. Because if our scuba diver has to go around the iceberg all the time, every month, they're not going to get it done. Just not going to. In fact, we had one client years ago, had a really bright controller. The controller worked remotely and would send the financials to the CEO with a proud email going, hey, they've been sent to you. They're on your printer. And what did the CEO get? A stack of paper about a 1/2 inch to 3/4 inches thick. Why do you think the CEO only looks at the top line and bottom line? There's no way that they have time to digest all that stuff. So organizing your financials to look like an iceberg is very important. The most critical information is the most visible information. Here's another mistake that we see all the time. Not all the time, that's an exaggeration, but for some of y'all that know me, you know I exaggerate all the time. I ran across a company and their financial statements were 37 pages long. 37 pages. It's virtually impossible to go through 37 pages of numbers and understand what the heck is going on. So if you have excess complexity, it means that you have flipped your iceberg upside down and you're showing the 90% and you've buried the 10, which means it's almost impossible for you to make a decision. Those numbers aren't meaningful. And a lot of times that's exactly why the CEO is back to that half-inch stack of paper, and they're only going to look at the top line and the bottom line because that's really all they have time to process. So ideally, even your income statement should look more like a decision tree. I started out here with gross profits because gross profits is really the key. I really don't care how big your revenue is, but I really care about your gross profit. The bigger the gross profit, the better. I used to tell back in the day when I had a construction company, I would tell my salespeople, like, hey, look, we're starting out the year. Here's the one thing I really want you to do when we're doing our budget for this year. Your personal plan is to sell 1 yard of carpet for $1 million. And of course, they came back and said, that's not possible. It's like, maybe, probably not. But I want you to get as close as possible because the larger the margin is on the single transaction means that we're going to have lower complexity and lower risk structure in our business. So gross profit could be driven by our revenue, the mix of revenue, the pricing of revenue, maybe the channels that we're going into. Certainly reoccurring or project revenue, radically different as far as its value. We're going to touch on that a little bit later on. And then what is your COGS really telling you about your labor productivity, your purchasing capabilities? Are you losing or gaining more and more control over your vendors and your purchase price points? These things, when dissected well, will tell you very early on that you have a problem. You don't have to wait for the avalanche to come all the way down the mountain to know that you have a problem. That's why looking at it this way, and then creating great KPIs will tell you very early when these things are off track and make it much easier to get them on track. The faster you can find things that are on track is also the faster you can get them back on track. So I think I said that backwards. The faster you can find the things that are off track is the faster that you can get them back on track. That's a better way of saying it, I'm pretty sure. So let's just start out with revenue. Because let's face it, it's still the most important top piece of the bread. And there's no way I'm going to have a P&L conversation without talking about that. So here we go. The number one truth is your revenue is not created equal. And if your revenue is just showing up as a single line on your P&L, you already have a problem. Because unless you're selling one product, it doesn't reflect what's really going on in your business. It also doesn't reflect the different value streams that you have created in your business. Revenue is a great indicator of value streams. So for example, here's my favorite metaphor about the value of revenue. Okay, here's two piles of revenue, and which one would you like to have? Well, most of us are going to go for the diamonds, of course. Why is that? Well, diamonds will fit in my hand, right? They're easy to hold. I could put them in a safe. Safe could be bolted to the ground, so they're easy to store, to keep secure. And they're extraordinarily valuable, and most people want them. This pile of gravel over here, not nearly as valuable, certainly on a per pound basis, and it requires a boatload of equipment to move around and everything else like that. And for a lot of industries, there's some exceptions, but for a lot of industries, commodities tend to go at a very low margin. And why is that? That's because everybody has them. You could get gravel anywhere. As long as you have the contracts to go to a rock pit, anybody could get gravel. Getting diamonds, very hard, very hard. So this is just one of those things about what's the value. And there's different ways of looking at value of your revenue. So let's explore that for a second. Here's kind of our organization chart for the value of revenue. And these are really radically different. So low risk revenue is very valuable revenue. Why is that? Because there's a very low risk that it won't reoccur year after year. So the higher the likelihood it is that your revenue will occur every year, or maybe occur and increase in margins, the more valuable it is, right? So think about that. So if you have different revenue streams, it would be great to see these 2 or 3 different revenue streams on the face of your P&L. It will answer so many questions for you right off the bat about, are we growing the valuable part of the business or is it shrinking? Is my margin affected by my sales mix, like the low margin versus high margin, or what's going on? Or did I have, some other kind of mess up on my execution? But if you can go from long-term contracted services, NetSuite, in those that people may sign up for years and evergreen for years, that's a very valuable revenue stream. That's why they spend so much money just trying to not only get subscribers, but also to make sure their subscribers aren't faking them out with a bunch of fake subscriptions. And then as you go through some of those things, it goes from contract services to subscriptions, maybe ongoing agreements. And then as we get into what I'll call reoccurring revenue, so that might be a project-based deal, but the client has several hundreds or thousands of them. One of my favorite examples there is when they were building out the cell towers. I had a contract, or somebody had a contract for doing 10 cells towers. So I did that. And if I did them well, I'd probably get the next 10 and the next 10 and the next 10 and the next 10, because there had to be hundreds of thousands of towers built across the country. So that's reoccurring revenues. Consumables also represent a good example of reoccurring. I brush my teeth, I use the toothpaste, I throw it away, I go buy more. That's why they spend so much money on branding. They want you to buy their toothpaste over and over and over again. Now, things that are a lot less valuable is a project revenue. So in my old company, construction, every January, my revenue started at zero for the year, and it literally had to be recreated every year on new deals won. There was no foundational revenue that was coming across that was helping to build more and more security in my business. The only way I could grow my business is I had to grow more people, more projects, and everything else, which means that I'm not adding operating leverage to my company. And by operating leverage, here's a good quick example of operating leverage. I have 2 people, right? That's my total company, and my revenues are 500,000, right? So if I can get to 700,000 and only on 2 people, I have a lot of operating leverage. But if I go from 500,000 to 750 and I go from 2 people to 3 people, I didn't get any additional operating leverage. I'm just having to put more cost into supporting that revenue. I hope that makes sense. If not, give me a holler. We'll talk about that just a little bit further as we go. The other types of revenue that are very low value is customer concentration. Now, I've heard companies go, oh, that's not really concentration. That's 2 different departments of the same company. I'm like, I don't care. Anytime that you have one company that has more than 25% of your revenue, you have a problem. Back in the day, I used to do some banking. And here was our universal stress test if you were one of our potential clients and one of your customers was Walmart. So we would not only look at the 25%, like if you were over 25% with Walmart, it was a problem. We would actually financially stress test your businesses. If you lost the 25% tomorrow, could you still stay in business? Now, for a lot of you are thinking, I'm not going to lose my biggest customer overnight. Well, if you're this big and they're that big, you're barely on anybody's radar screen. I mean, at Walmart, they used to be famous in the day for just stop sending you purchase orders for a reason that they never reported to you and never gave you time to adapt to. That's exactly why we had that stress test. If you could not demonstrate that you could stay in business overnight, if those orders stopped overnight, then we probably wouldn't bank you, because Walmart could stop your orders overnight. That gets into not only how high margins you are, but also gets into your balance sheet, which we'll talk about next time. Because the more risky your revenues are, the fatter your balance sheet has to be, because you need more flexibility and cushion when your income statement shifts very quickly. So let's look at an income statement, and let's talk about what we like or don't like and what this income statement is really telling us. Now, I hope all of y'all, number one, always have an income statement that compares one period to another, right? If it's just showing you one period, I'm telling you, you're not getting a whole lot of information. But when we start looking at one period to the next, a whole lot of nuances start becoming available, interesting, everything else. And I know I'm kind of geeking out on you because this is what I love, maybe not what you love, but I'm going to share some observations and hopefully you'll love it too. So let's look at their revenue. We have their standard revenue and we have their private label revenue. So what this says is their total revenue is up by 47%. Hopefully you can see me highlighting that over here. But it's really driven by their private label revenue and not really their standard revenue. They're both growing, but the private label is really growing a lot. Now, in most companies, the private label is a very high margin item because it's their own label in this case. So that really, these two product lines have wildly different margins on them. It's like a 5-point difference between the two. So as the mix of these things starts to change, this is really very important. So over here we have the mix. We have 75% and 27%. And if this one's growing much faster than everything else, and it is our high margin product, that means the health of our business is radically improving as we look at this. If I only looked at 2021 in this scenario, I'd have no clue about the transitional health or the transitional decline of the health of my business. These variances are hugely important, and this mix will help to explain your margins more so than any accountant standing up in front of the room presenting you with the numbers. Now, as I go down, you'll see that I have direct labor, direct materials, and other direct materials. In this case, other direct materials is freight. So just know that. And why do you think I have these three things highlighted? Well, health and accountability. So for a lot of companies, when you're doing your month-end financial summit, who else is in the room? It's not just you, the CEO, and your accountant or controller. Hopefully it's you, the head of sales and marketing, the head of production, and the head of your other functional areas. In this case, I'm hoping that the head of production is in there, who owns labor, direct labor. I'm hoping that the head of procurement is in there, who really owns the biggest part of direct materials, negotiating those prices per unit. And then I hope that maybe my fleet manager or my logistics manager is in there, who owns my direct materials. I also highlighted these three boxes because they should move in lockstep with my revenue, right? Over time, this percent of 16% should be highly consistent. Just because my revenue goes up, then my direct labor should go up by 16%. Ideally, if my revenue goes up by 16%, I'd like my direct labor to only go up 15%. Because again, that means I'm creating operating leverage, right? Makes sense? So here we have an increase of 47%, and our direct labor went up 48%. Right? So let that sink in. I actually lost operating leverage. Something happened in my labor from one period to the next that means that my labor became less productive or more expensive per dollar of revenue. Now on direct materials, we picked up some ground. Maybe my procurement manager, she went out and negotiated some great deals and picked up a few points. So that's great. Revenues grew 47%. My materials only grew 46%. So she created 1 point of additional margin by doing that. So she can go out and celebrate while my direct labor person, my plant manager, is going to go out there and sharpen their pencil and find out what the heck happened and why are we not doing as much, whatever the case may be. Then on here on other direct materials, during this time frame, this is when fuel was going through the roof, right? Because everything was shut down. So you can see that went way up. In fact, our revenues went up 47%, great, but this went up almost 80%, which is huge. So the question there is, okay, maybe gas and diesel went temporarily way up. When will they come back down? When will they normalize? And what kind of mindset do I have? But, oh, I see this trend, but maybe in another 2 or 3 months, that trend will go away. Now you have accountability. Somebody has an action item to make that trend, monitor that trend, and make sure it's going away by how you're buying fuel or buying transportation services. And just by setting that expectation, that person now is responsible for coming back to you every month saying, we're on track, we're off track, for making sure that we can drop that new number to the bottom line. You'll see that I did not include, especially rents and leases. If you're in a manufacturing facility, you're going to have fixed costs that are up in your gross margin. And if you look at just these three components, which move directly, they are variable expenses that should move in proportion with your revenue. Those percentages should always stay the same. Your fixed expenses, this is a good example. Our revenues increased 47%. These barely changed because they're fixed, right? But if I look at my gross margin, because I had these fixed, my gross margin will kind of bounce around. But my contribution margin, that is gross profit adding back rent and leases and possibly adding back these indirect. My contribution margin should stay very steady with my revenue. It's an easier way to eliminate some of the static that may come across if you're looking at your gross profit percentage, if you have like fixed costs of leases and rents in there as well. Again, some of y'all are not used to that concept. Give me a holler or shoot me an email or pop a message in here, and I'll follow back up with you about a more detailed example about how that happens. As we come further down, you'll see that I have clustered expenses into one of four categories. And I do that because these four categories better align with how you make decisions or how you analyze costs relative to what's going on in the rest of the income statement. For example, sales and marketing. And I want sales and marketing to include the compensation and commissions of my salespeople. I want to see a certain level of productivity that is happening with my sales folks. So over time, is my sales and marketing becoming a bigger percent of my revenue? Okay, well, what does that tell me? Probably one of two things. I've launched a whole new marketing program or a whole new product line, and it's requiring a big effort to get it up and going. That's an okay deal as long as you have some timeline about when that should renormalize, and those sales on those new products should catch up. Or it tells me that my sales or marketing efforts are being less productive than they used to be. That's a huge, huge red flag. And when that happens, you and your team need to back up and go, whoa, we used to be, gosh, in this case, they're at 5% of revenue, which is really low, quite frankly. And let's say in this case, they're 5%, but they used to be 10%. Well, that's total celebration time. They were becoming wildly successful at their sales and marketing efforts. But that used to be 3%. Now it's 5%. Then that means we're becoming slightly less efficient. So that's when you need to step back and says, is it working as expected? Is this because we're launching those new products? Or is something else going on that I need to address now before I keep on just throwing this money at this thing that says it's broken? Because when these numbers and percentages start to change, they're yelling at you going, we're broken, fix me, help me, do something. That's why looking at comparative numbers is so much more important than looking at just a solid column of numbers. I look at sales and marketing for that way. I look at G&A employment because it's the number one most controllable expense you probably have. And when, in this case, so revenues went up by 47%. Gosh, this only went up by 37%, which means I'm getting great leverage on my administrative tasks and people that are not on the plant floor. That's fantastic. But sometimes what will happen is entrepreneurs, very optimistic people, they will start hiring for future planned revenues that are not yet coming in. And they can get into real trouble on this to where their G&A employment expenses starts growing much more rapidly than their revenue. We have a metric later on that we're going to talk about that really helps us control that. And then discretionary, well, that's, your insurance, your consultants, your banking stuff. And it might be some things that are pretty easily cut, like travel, things of that nature. So it helps out a lot. And then fixed expenses, I put those in there because you really can't change them. Getting out of your lease, getting out of your building, very expensive processes. So you really want to start looking up these categories to determine where you're going to make changes, depending on what's going on with your company. Lastly, when we're down here, while this company has improved wildly from a $61,000 loss to $600,000 profitability, they're still only at 2%. 2%. That's just barely above break even. That's not good. Even though that this is much better, it's still not good enough. This company probably has, because it's in manufacturing, I'm going to say a benchmark between 5 and 8% bottom line. So that's where the benchmarks are really important. Hey, we're celebrating that we got the 2%, but we're still supposed to be at 8. What are we doing? What would it take to get to 8? Now, here's a really interesting way to be thinking about that. I call it turning your income statement upside down. So it's an exercise. You'll see the 2% up over here. And so the exercise I'd take a company through or through your management team and says, hey, look, we're going to turn this company upside down. We're going to change that number from 2% to 8%, right? Which is now that's 4 times this 600,000. So that's 2.5 million or whatever that we should be getting. Yep, that's right. So what would we have to change to make this 2% into 8% to make this $600,000 into like 2.3 million? And what I challenge them on is you can change everything in the company except for volume. So you really can't change revenue just by saying, oh, we're going to sell more. It's okay if you change pricing, right? So that's a hard action, and I highly recommend it because it drops right to the bottom line. So you can change pricing, but you can't say you're going to grow your way out of this problem, especially if you're below average on your benchmarks, because it means that systemically you have process problems that your competitors don't. It also means that your business is riskier than your competitors. And if any of y'all are thinking about selling your business, it also means that your business is less valuable, not just because it has a smaller EBITDA, but because that smaller EBITDA is associated with even a bigger risk, right? So two things are compressing the value of your company: size of the EBITDA and the order of magnitude of how low your deal is. So challenge your people. And what you're going to discover if you ask the questions well is that you have a lot of process problems. And over time, what we have found is people with process problems, they will throw bodies at the problem. Oh my gosh, we're late on this. Wait, we still have these things jacked up. Products running late. So let's put more bodies on it. Let's put more bodies on it. Let's put more bodies on it. And they keep on dogpiling bodies to digest the problems. So for y'all that have been with me before, what's the number one way that I say is the easiest way to solve a problem? Let's make sure it doesn't come in the door, right? And what that really means is let's step back and explore the root causes of why these problems are here in the first place. Because if you solve that, and if you really did a Pareto analysis about which problems are consuming the most time, and you took the biggest ones first, you're going to be stunned at how much time you start freeing up. You're probably also going to be stunned at how much your people thank you for making the problems go away versus just making their jobs more laborious by trying to grow and just increase the number of problems that come up. So that's universally, not universally, but that's typically a big cause of why you're underproducing, because you have really jacked up processes compared to the norm of your industry. One easy thing to do when you're turning your income statement upside down, and I can send you this spreadsheet. It was provided to me by Cheryl Clutter of Convene. Super bright gal. She's, I always consider Cheryl a sister from another mother because she and I think about finances a ton. This was developed by her, and I don't think she'd mind me sharing it, but it really goes through the power of one. Because somebody thinks, oh, I got to do huge things to change my business in a massive way. Nope. A lot of times it's just the little things that start to leak a lot of money to the bottom line. In this case, the actual data showed that if they just did these 1 days or 1% in all these categories, they were able to double their profitability. Double. Because this is a 1 month snapshot for this company. So it's not the big things that you do, but it's the little things that you do done well over a long period of time that have tremendous impact. Back in the day, we had one client, and it was a software implementation kind of project company. And they had 50 programmers and software folks. And what we asked is, hey, out of the 50, how many of y'all might do 2 or 3 hours of work a week that really could have been a change order, but you're like, it's only 2 or 3 hours. What do I care? I don't want to go through the mess of that. You know what? All 50 of them raised their hand. So it's 50 people times 50 weeks. We're going to give everybody vacation, of course, times their bill rate at $250 an hour. Do you know what happened if they were to capture all those lost hours in billable time to their profitability? Well, this company was performing at about 1/3 of the benchmark profitability. Instantly, overnight, their profitability would have exceeded average, and they would have been more like 60% or 10% above average. So just by doing the small things well and capturing the obvious, it's stunning what that will do to your profitability. So on pricing, this is a pricing matrix that we have. And this is an easy way of thinking about your pricing because most people live in fear of making a price increase. We got engaged with one company one time, and literally it had been 7 years since they raised their prices. 7 years. And I don't know about you, but inflation did not stay flat for 7 years. I don't care what time period it was. There's no such thing other than the Great Depression, right? Where inflation was not impactful. So what this says is, hey, if my current gross margin percent is, in this case, 40%, and I'm thinking about raising my prices 5 or 10%, then if I raise it, I'm at 40%, I want to raise it 5. What this says is you could lose as much as 11% of your customer base and be okay, which makes for a really simple decision-making model. If I raise my prices 5%, do I think I'll lose more than 10% of my customers? If that answer is, oh, heck no, then go ahead and raise your prices. The same thing is true if you're at 40% and you're going to move it up by 10%. So now we're going to go from 40 to 50% margins. Then what this quick matrix says is, would I lose 20% of my customers if I raised it 10%? And if that answer is, oh, heck no, then raise it, right? Where that's really important is you're not only raising your prices, which all drops down, and you might lose some customers. So you're shrinking the volume of activity. So what just happened to the risk profile of your business? You're raining more money on fewer transactions, which means your risk profile went down and the value of your business went up, right? So sometimes pricing can be a really powerful tool to make sure you are selecting the right customers that you should be having. Again, if you would like to have this matrix, I have a whole write-up about not only the matrix, but how to use it. Happy to give it to you. Just send me an email. Trends and comparisons. We've already talked about this a lot. And we're going to take this a little bit further because the trends and comparisons that we talked about previously versus the prior periods, we went from 21 to 20 in that one deal. Budgets, or do you have a budget? So how are you trending against your budget and your expectations for the year? Your benchmarks, do you have industry benchmarks that you're trying to hold your team accountable, or just the trailing 12? Now, one thing is we're talking about comparisons. I'm going to give you one of the most important comparisons of all. Before you ever look at your financial statements, there's one thing I want you to do. Or when you get your financial statements from your controller, here's the one thing I want you to do. Don't look at them. Don't turn them over. Don't flip the first page. Don't go look at your revenue and your net income, which are items 1 and 2 on your top 3. Don't look at them. Step back for a day or at least a couple of hours. Says, what happened last month? How did last month go? What things happened in my business? Sales promotions, I had shipping problems. What things happened? And what do I think how that will be reflected in my financials? If you go through that thought process, you're going to have a much better mental picture about what your financials should look like. Then when you open your financials, you're going to have a different mindset about your expectations of what you want to see. And when you do or do not see that, you're going to be able to ask a whole lot better questions of the controller or your operations person or your marketing person. I expected to see X, Y, and Z. Why is that not showing up here? What happened that I didn't anticipate or understand? And the accountability within your leadership team, and certainly within your controller and accounting team, will go sky high. They too will start looking at the financials very differently. So my metaphor here is take the time to think about your business, mentally build a picture that you expect to see on the puzzle box. And once you have a vague idea about what the picture on the puzzle box looks like, then open up your financials and see what that picture really looks like. You'll be stunned at what a better person you are at looking at your financials just by doing that. The other thing is when you look at trends, look up and down your financials. Are those relationships holding true? is my direct labor always 25%, or did it go from 25% to 32%? Did it go from 25% down to 23%? So those things are telling you about the relationships in your numbers and your ability to execute. When you start looking at trends across time, especially trends that are interrelated, what you're going to see is when processes or decisions got broken. It's stunning when you look at it that way. You'll see two lines kind of go in, they'll break pattern, right? As soon as you see them break pattern and the break remains there for a month or two, then you need to ask your team, what happened? Something in our company, did a person change? Did a vendor change? Did our purchasing agent with the vendor, our buyer agent with the vendor change? Did we change systems? Did we change process? And if you just basically ask yourself, when you see those breaks, did a person in or outside the company change? Did a process in or outside the company change? Or did a system inside or outside the company change? Asking those three questions will allow you to get to at least in the ballpark of your root cause problem real fast. And then you could ask your people to explore that further. And you're going to be stunned at how fast you can find that problem and get it corrected or get it renegotiated. But the longer you don't see that shift in the relationship of your numbers, the more detrimental it is to you, especially if it has something to do with your customers or your vendor, because they're going to sound, oh, we've established a new norm. This is the new norm. The old norm is gone. But the faster you find them, keeps the ability for you to keep your old norm. Now, margins. We've gotten into companies before, and if you go month to month, their gross margin percentage, now we're going to act like we don't have leases and rents in there, and it's just all stuff that's supposed to be variable. And their margins are just jumping all over the place. It's 50%, it's 22%, it's 35%, it's 43%. It's just all over the place. If your margin percentages, not your margin dollars, but your margin percentages are jumping all over the page, then I'll tell you, if you showed that to your banker, your insurance company, or your bonding company, they're going to tell you something's drastically wrong with your company. And when those things come into is, especially if you're in production, manufacturing, or construction, project delivery of some kind, it's telling you that your proposal and estimating process is jacked up, right? You're missing very significant costs, or you're over or underestimating what those costs actually are, or how they are acting in your company. So perhaps you want to go back and re-examine your proposal and estimating processes. The other thing that highly volatile margins are telling you is your ability to execute is sporadic, that your underlying processes, in EOS, they call it FBA, followed by all. It's not being followed by all. In fact, maybe nobody's following it because it's all over the place. You do well one month, you're doing horrible the next month. The people in the trenches really don't understand their jobs and what success looks like. So estimating your proposal is jacked up. Your operational ability to execute and execute well is jacked up, or your dance partners are out of step. That's OOS. And by that, especially in construction, manufacturing, and project teams, this dance between your accounting team and your operations team has to be very close. They need to be communicating all the time, because otherwise your margins are going to be all over the place. And when your margins are all over the place, you may go, oh, that's okay, it'll fix next month. But here's the real problem. Not only is it telling you that you have a problem, right? The real problem is you are consistently producing false negatives and false positives in your company, which makes it hard for you and your team to say, this is really a problem, we need to take action. Or this is really great and we need to do more of it, because they just don't know. They don't know if it's going to bounce around next month, or if this is signaling something else in your company. So if your dance partners between accounting and operations are not dancing well, you need to get them in the same room and start talking about the same language. We have a couple of tools that have we use to highlight that real quick. Just things that you can do on an almost interview basis. And it's an organization chart is what it looks like. And it's all about driving profits. And we will have people, we'll get the accounting team, each 3 dots of one color, the operations team, 3 dots of a second color, and the estimating proposal team, 3 dots of a third color. And then we go through all the drivers of profitability, and everybody gets to vote their 3 dots, right? And it's stunning when you see how all the 3 dots by department start aligning up. And that's really interesting because then you can talk about what do you see that I don't see. But what's also interesting is when all the dots start going on to one or two central areas. And what's great about that is it's a very quick way to have everybody going, you know what? I see that problem too. And so they become partners in solving that problem when they just thought, oh, well, Larry's doing whatever Larry's doing again. We just can't control Larry. No, we all see it the same way. That's a problem. We need to fix it. So some of my favorite metrics as far as income statement that we're going to blow through here real quick. We have 10 more minutes. I hope you're enjoying every minute of it. Are these key metrics to drive P&L performance? A little Julie Andrews steal here of here's a few of my favorite things. So on revenue mix, I want to know my recurring versus non. I want to know my high margin versus low margins. And I want to know the revenues of my rising stars versus my cash cows. That comes from, what is that? Boston Consulting Group, the rising star, cash cows, dogs, and question marks. But depending on if you have some of those things, you want to be able to see those on the face of your income statement. Because it'll tell you profound things about what's going on in your company relative to your initiatives to move the company forward or relative to your initiatives to drive a more consistently profitable company. Now, sales targets and sales effectiveness. Most of you are going to go, why is break-even point on sales effectiveness? Here's why. Break-even point is one of the most important metrics that you will ever use in your company, ever, ever, ever. Where it's really powerful with your sales folks is it tells them that, hey, look, at the current margins that we're selling at, here's the bar that we have to get over every month. And now you have a target of minimum sales that they need to be solving for in the next 30 days. And once they get good at that, ask them to solve for it in the next 60 days. They get good at that, ask them to solve for it the next 90 days. Like, is your pipeline strong enough to make sure that we will exceed our break-even point in the next 30, 60, and 90 days? If you can do that, you're never going to have a month in which you lose money, right? Unless you have some big shock and awe thing going on. But it creates the bar about what's your break-even point. You can even take this further, says, here's our break-even point, but here's the revenue we have to have relative to our cost and margin structures to make 10%. So now everybody on the sales team on that same 30, 60, 90 basis knows what their pipeline has to look like for them to consistently achieve now 10%. What's really interesting on this though, when people start asking you for, gosh, I need to go spend more. We need to, expand this. I need to increase our expenses by $100,000. Well, that $100,000 is going to increase your break-even point. Right. So break-even point is all my SG&A expenses, what I call OPEX, divided by your gross margin percentage, which grosses that up, says this is the revenue we need at that gross margin to pay for all this. So when somebody asks for, I need another 100,000, let's say that your margin is 33%. So like, that's fantastic. I think that's a great idea. Can you tell me how long it's going to take for that $100,000 to produce $300,000 worth of more revenue? I'm like, what are you talking about? Well, that's our break-even point. I need a 3-for-1, right? So every time that somebody's asking you to invest more in operating costs, operating expenses, just know that they should be able to demonstrate how it's either going to improve margins or improve the top line. Margins is the other thing. So let's say that I have $100,000 of operating expense, and my margins are 25%. So every time that changes, that means for that 100,000, I now need $400,000 to break even. But let's now say that I can somehow get my margins from 25% to 50%. Well, now all I need is $200,000 of revenue to pay for that $100,000. The risk of my business went down. So as you look at that, it helps you to create what's my sensitivity to increasing my margins. It takes the stress off the sales team. They don't have to sell as much stuff to cover all the fixed expenses. It also makes you much more sensitive to your cost that you're throwing in there because you have to cover those costs with more revenues. I love break-even point. Customer acquisition cost, you hear about that on Shark Tank all the time. It's mostly for those people that have subscription-based services. They want to know what is your customer acquisition cost. And they might even get into lifetime value of a customer, but we're not going to go down that rabbit hole. Customer acquisition cost is really easy for, that period of time, month, quarter, whatever. What's the total amount you spent on sales and marketing divided by how many new customers you got? It could be used a slightly different way. The other thing that I like to always do is my sales and marketing expense as a percent of revenue. We talked about a little bit before when we look at the company that had 5%, but if it goes from 5 to 10, that's not good unless we're investing in that product. COGS, labor and materials. Track both of these as a percent of revenue. They should be very consistent, very consistent. And if they break that consistent pattern, you have a problem or you've done really well. But the breakage of the pattern tells you something very important. It's also interesting to see both as a dollars per unit, right? Because that'll tell you something about your pricing, you're negotiating with your vendors, things of that nature that may give you different ahas about who's accountable for what and what to do about it. Lastly, just revenue per direct labor head. I always want to see that because it is a universal, easy number for the direct labor folks and managers that says we're either increasing productivity or we're not. If they want to have a 3% raise, then that thing better increase by 5%. Otherwise, the raise itself is being dilutive to your profitabilities. Administrative effectiveness, gross profit per admin head. Very similar to revenue per head, very similar to revenue per sales head. Only now we're making sure that below the gross profit line, we're not throwing bodies at those problems, right? You don't want to see that going on. In fact, accounting's a good example of this. If your revenue increases by 50%, should your accounting staff increase by 50%? Oh, heck no. Oh, heck no. And if your controller tells you, oh, heck yes, you probably have the wrong controller. Or something's really wrong with your processes, or something's really wrong with your system. It's one of them. But you should not be growing those expenses as fast. That's operating leverage. The other thing that's really cool is operating profits, gross profit per admin head compared to average compensation per admin head. We did this for a company one time, and what it showed is that spread kept on getting thinner and thinner and thinner. It was getting down to a crisis point because they were throwing very expensive bodies at these problems, but it wasn't driving the solutions on the margins. So that's another good way of looking at it. Taking it to the bottom line, EBITDA per head. The other thing that I like is EBITDA per head compared to the benchmark EBITDA per head. So there's a couple of critical measures that you can get out of a benchmark report. Number one is revenue per head. And as soon as you know revenue per head, you know the average number of headcount within a business. And then from that, you can do gross margin per head. You can also do gross EBITDA per head. And the other things that you can do is then you can compare what your number is compared to the benchmark numbers. And are you below? So it tells you a whole bunch of things about your total cost structure relative to what's dropping to the bottom line. You also see up here that I have, where to go? Gross margin percent versus benchmark margin percent. What is that delta? That's a really important thing to be monitoring. The last thing I'll tell you about these KPIs is once you develop them, have a canary in the coal mine. Have a targeted performance that you think your team needs to be hitting, because that'll tell you I'm okay and I can keep on chirping, or this air is getting pretty toxic and pretty soon I'm going to fall over dead in my cage. Either way. So with that said, I'm going to turn the mic over to y'all, and I'd love to see if y'all have any questions. I'm not sure how many people we still have on. 8 folks are still here, so that's fantastic. So y'all let me know if you have any questions, because I'm happy to answer any of them. I see that we have a few CFOs on with us, so they probably already know all these answers. But for those that don't, love to have you ask some questions. See if you can, if you will, stump the chump. Lola, did anybody ask anything? I see one chat deal. Let me see what that is. Oh, well, thank you, Leslie, about the picture. I'll take that one down. That really wasn't the kind of question, but thank you, Leslie. That was very kind of you. Anyone else have a question? That's the good and somewhat embarrassing thing about having good friends jump on these too. Well, if nobody has any questions, please know that I offered up several times for different things just to text me. You can do it on LinkedIn message, a DM, or whatever the case may be. As far as would you need a benchmark report? Would you like the pricing matrix or some of the other tools that we talked about? If you send me that message in LinkedIn, we'll be happy to turn those around. And for those of y'all that would like to share this more with your direct reports or your leadership team, we will make this recording available to you once it's fully recorded and all ready to go. With that said, I'm gonna let y'all go. Y'all have a delightful Friday, and I hope a fantastic weekend. Thanks for spending your time with us this Friday afternoon with LinkedIn Live with New Life CFO Services. Y'all take care and have a good one.